I have analyzed many of the recent stocks that Warren Buffett has been buying as of recent. I looked at Occidental, I looked at Siri, and I have to admit, this is by far my favorite company that Warren Buffett has recently purchased, or I should say Berkshire Hathaway. It's a very good company, high quality stuff, wide moat, you just can't come in and take away their business model. It's like a toll bridge, you could say. You have to go in through this company and pay them their fee. It's a beautiful business model. I'm gonna talk about it. Very quick video, very quick overview, give you my opinion on the business model, fair value, let you know if I believe it's presenting an amazing opportunity at this price, or maybe we're too late, or maybe there's another alternative for the kind of multiples that you're paying up for this amazing company. Because I always say it's not much about what you buy, but it's also how much you're paying. And even if you buy a good company or a quality company, if you pay too much for it, you might end up losing money. So I hope you enjoyed this video, and I hope you get some value out of it. And Berkshire Hathaway has been buying a lot of the stock as of recent, over $5 million, $6 million, $3 million, very recently, over the last few days, he's been buying a lot of the stock. And this stock is VRSN, VeriSign, I believe this is how you pronounce it. It hasn't done much. It's up 2% over the last year. It went up a little bit recently because, Berkshire Hathaway has been buying it. Over the last 5 years, the stock is only up 2%. Hasn't even kept up with inflation. So it's been a disaster. It hasn't really done anything. It had a little bit of poor management. And, I'm going to talk about it. And it's a very interesting business model. And I didn't even know the company existed. They mainly own over 169.6 million domain names. And the domain names are the .com and the .net domain names. So they own the name .com and .net. So if you go on YouTube, youtube.com, they own the name .com. You go whatever .net, they own the name .net. This is amazing. I didn't even know the company existed. This is genius. I mean, just think about it. So if you want to go on whatever website, GoDaddy.com or whatever, you want to create a website, whatever it is, .com, you have to pay this company a fee to get the .com for your own website. This is an amazing business model. Amazing. I didn't even know the company existed. So it's a genius. It's a beautiful business model. That's a good buy. I mean, that's much better than Siri, in my opinion. I didn't like Siri too much. That's a very bright idea. I'm loving it, guys. I love the idea. And I looked into it. It's a business model. It couldn't be better. It's an amazing, it's like a toll bridge. Amazing business model, over 169.6 million, domain names, amazing stuff. But there's some good things and bad things about it. No business is perfect. The first one is, I looked at, this chart which says this is the 10 largest, domain names or whatever. And .com is the largest at 156.7 million. And the renewal rate is 72.2%. Now, 72.2% is high, but I was honestly expecting it to be a little bit higher. I mean, I was surprised that it wasn't a little bit higher. I thought maybe it would be like 85 or 90%, but it was 72.2%. And, that kind of surprised me a little bit, I have to admit. And you could see from here, this is, in terms of their charts, the domain names, they went down 1.1 million quarter on quarter, and they've been kind of going down over time. And this is something you have to pay attention to. And if you look at the growth of the company has been very slow. Revenue is only up 3.8% year on year. Operating income is only up 5.9% year on year. So the revenue growth isn't really there. And the main reason for that is the company has to legally sign some kind of documents with, I'm not an expert on it, to be honest, but there's some kind of an institution called the NTIA, and they have to sign some kind of contracts for internet security and stability. And this contract kind of caps their prices of $10 per domain name per year. And it would allow them to only increase prices 7% for 4 years out of the next 6 years. So they can only increase prices around 7% for 4 out of 6 years. So that would only leave them with so much in terms of price increases. And the domain names, they've been growing, but the renewal rate is 74%, isn't 85 or 90%. And quarter on quarter, sometimes they've been going down. They haven't really been going up. So that would leave the company without much growth. And if I had to estimate the growth for the company, I would not be betting on more than the 7% increase that they've been signing in those contracts. So this is kind of why, the stock has been flat over this period, is because yes, it's an amazing company, high quality company and all those things, a wide moat, you cannot come in and take their business, but the growth isn't there. That's just, they have this business, but they cannot go and acquire other companies. I don't believe it would be a monopoly. They would have a hard time with the Justice Department. And they can't do much besides buying back stock, and maybe doing dividends if they decide to do dividends. But they've been buying back stock and, just doing whatever. And they can't really do much to grow the business. And they can't hike prices above 7%. And, they're stuck in a bad situation. And that's just the way it is. Now, looking at the ways they were able to grow earnings per share, because earnings per share has been growing a little bit faster. If you look at, revenue, it's 3.8%, but earnings per share was 13.1%. And the company was mainly doing a few tricks. And this is a trick that, McDonald's has been doing, Pepsi's been doing it, many different companies. And they mainly borrow a little bit of money to do a lot of buybacks to inflate earnings per share. And this is not something out of the normal. A lot of companies been doing it. And you could look at 2023, they repurchased $900 million worth of shares, but free cash flow was only $800 million. Same thing in 2022, they borrowed $1 billion, or I should say they purchased $1 billion, and the free cash flow was only $800 million. So they kind of did that, and that's why earnings per share was at certain times, 10, 12, 13%, and revenue was like 4 or 5%. And this is something to keep in mind. But as I said, the company is an amazing company. Net income margins this year were around 50%. So 50% net income margin, just amazing. So for every dollar in revenue, 50 cents goes into the bottom line in net income. That's just an amazing, amazing business model. This is higher than Microsoft, higher than Apple, higher than Nvidia, higher than most companies you could even think of. Amazing stuff. Looking at the history of earnings per share, it's been a little bit tough to predict. I mean, it goes from 7% at certain times when they borrowed to do a lot of buybacks and had certain things. It went to 13, 16%. This year was only 1%. Next year is expected to be 7%, then 5%, 7% based on the contracts that they signed that I showed you. And it's been all over the place. But if I had to bet on a fair number, I would not be betting on more than the 7% we saw in the contract. So I would bet on 7% average earnings per share growth over the long term. So we're getting 7% on average earnings per share growth over the long term. And we're getting around 50% net income margin with a very wide moat company. No one's going to come in and take the .com name or .net or come up with some kind of a fancy whatever name that's going to take over the .com from YouTube or Apple.com or whatever it is. And it's just a beautiful business model, beautiful name. And we're getting it for around pretty close to 25 times earnings, 24.7, almost 25 times earnings. The mean was 28.8 times earnings. It went as high as 41 times earnings and as low as 18 times. So where it's currently trading at right now, at least on a historical average, it's not too expensive. It's not too expensive at all, at least on a historical average. So for me personally, the way I would look at it, for such an amazing business, such a wide moat, 7% earnings per share growth average, not too bad. 50% net income margin, one of the highest you could find in the stock market. It's not too expensive. It's not too bad. And if I was not expecting, like without a multiple expansion, I would expect the total return over the long term to kind of mirror earnings per share growth, so 7 to 8% per year kind of return over the long term. And looking at Buffett with the billions that he's managing, I think this is something that he would expect, 7, 8, maybe 10% kind of, return over the long term. And it wouldn't be something that's too bad at all. And this is, again, excluding a multiple expansion. With a multiple expansion, if the stock gets back to, 30, 32 times, forget about it. It's going to be much, much more than 7 or 8% per year. It could be maybe 12, 13% per year. But for me personally, if I was dying to own a quality company with a wide moat, I would not be buying VeriSign. I always try to keep it real, and I'm trying to do it again with this video. I would not be buying VeriSign. For me, if I was dying to buy a quality company and I was willing to pay up, I'm just being honest, I would be buying Visa. This company is trading at almost 25 times earnings. You could pay 3 points more, and buy Visa at 28 times earnings. Visa has as good as a business model, as good of a moat, in my opinion, and even a superior moat for Visa than VeriSign, because Visa can at least somewhat control their own prices. And if we have 10 or 15% inflation and ticket prices go up 10 or 15%, you're going to have an automatic increase in 10, 15% of revenues in Visa, because then the fee stays the same, but they collect 10 or 15% more in terms of the percentage of the fee from the transaction. So it's such a beautiful business model. You pay 3 points more, get Visa at 28 times earnings. Instead of getting 50% net income margin, you get 56% net income margin. And instead of getting a fluctuating 7% EPS per share growth, you could get around 13 to 14% EPS per share growth, or earnings per share growth, I should say. So for me personally, if I was dying to buy a quality company, I would be buying Visa. And I do own Visa. I bought it at a much lower price. I talked about it on YouTube. But for VeriSign, it's not a bad buy. I would be expecting 7-8% over the long term, maybe with a multiple expansion, maybe 10-11% on the high end. It's not too bad. It's better than Siri, in my opinion. I mean, I think it's a very safe investment. It's hard to lose money over the long term with such a solid company, high quality company. But if I had to choose, I would be buying Visa, or I talked about CPs or railroad stocks or something else. I think there's better opportunities. But that's just my opinion on Warren Buffett's stock. I hope you enjoyed it. If you did, please press the like button and maybe consider subscribing. So I'll talk to you in another video.